I want to go and make sure we're looking at the codification. Now, there's not a lot written in the codification on this. So again, this is a presentation area. We'll make this a little bigger. And we can go right down to the statement of cash flows, which is ASC 230. And you can see there's only one topic, but there's some really interesting subtopics, if you will. So how is foreign currency affecting the cash flow statement? How is this affected for financial services companies, investment companies, not-for-profit entities? We're going to focus our time just really looking at the overall. Like I said, there's not much here. It's all about other presentation matters and disclosures. And there's really not a lot. It's going to define what are cash and cash equivalents, gross versus net cash flows, on and on and on, as far as our classification between financing, investing, and operating activities. So this is a pretty quick read as far as the codification is concerned, but we're going to do a lot of interesting things to try to figure out, can I create a cash flow statement from the rest of my financial reports? And that's really what I want you to be able to get your head around. Now, remember this from when we talked about, how we go from the entity and their product and service all the way down to the financial statements, the cash flow statement being one of those financial statements. And we had different objectives and sub-objectives for financial. But I really want you to focus your attention here in the processes. Because when you look at the processes split pretty well between the three different components of the cash flow statement. So anything that's going through the investing process is going to go into the investing section of the cash flow statement. Anything going into the financing process is going to go to the financing section of the cash flow statement. The reason why these are separated out is because we don't have a lot of transactions going through here. Where most of our transactions happen is up in operations. And operating cash flows, therefore, is the thing that anyone who is using the financial statements, they should be focusing their attention on operating cash flows. Because if cash is what we desire most, then I want to see how is your business actually generating cash flows, hopefully free cash flows, for potential future investing, to pay off what you've already borrowed as far as financing, or to pay the investors back in the financing process. Because as an investor, I gave you money, and I'd like to get some of it back. I'd like to get a return on that. So these two things are important, but there's not a lot of transaction flow in here. What's happening is all up in these particular processes. So as we think about recapping from your Chapter 4 discussion at your first accounting course that you took, we've got, think about it, we've got three different components of cash flow. So this is our discussion of the cash flow statement. And we have three different components, right? The three components are operating, very important, investing, and financing. And what this is going to do is it's going to give us our net cash from each of these, and it's going to describe, when I add these together, it's going to give me my net change in my cash balance. So I should always be able to look at my balance sheet and look at the ending balance last year and the ending balance this year. The difference between those is my net change in cash. These three components have to add to that net change in cash. If they don't, then your financial statements don't make sense. I tell all my students this. If you're constructing a cash flow statement and you can't get this to balance, plug it. It's called other. And it's usually a plug into operations. So don't ever create or give a out of balance cash flow statement. These three things added together have to equal your difference between your cash last year minus your cash this year. Whatever that difference is, these three things have to equal that. If they don't, then put it in other and make sure it does equal. There may be a reason. It's probably not material. I don't care. So there's three components and there's two methods that we use. And both of these methods relate to how we do operating cash flows. One is the direct method. And the other is the indirect method. If you choose to use the direct method, that's great. But you still have to do a reconciliation. You still have to do the indirect method. What? Wait. If I do this one, I also have to do this? Why would you ever do this if you have to do both? Well, the reason why you might do this one, knowing you have to do this reconciliation as well, is because there's some information content here that's important to your users of the financial statements. They might want to look at the gross cash flows. They might want to look at gross cash coming in from customers, gross cash going out to vendors, gross cash being paid to employees. They may want to see all of that. And so there may be information content that is valuable to the users of the financial statements, and that's why the direct method is used. But if there's no information content that's valuable here, don't do it. Just do this, because you have to do this anyway. If you choose this method, you have to do the indirect method. You have to disclose this indirect method reconciliation. So it just seems silly. And why do extra work when you really don't have to? So those are your three components and your two methods. We're going to spend most of our time looking at the indirect method. Because how you do the direct method? For direct method cash flows, you go to your cash general ledger account and you summarize each activity. So for example, I'll figure out cash collected from whomever, customers. And I'm going to just take that data and I'm going to add it all up. Then I'm going to look at cash paid to vendors. Cash paid to employees. So I just go into the cash general ledger account and I just add up all the ins and all the outs and I disclose that gross. That's a simplified way of explaining the direct method of cash flows. And then whatever you got to do, you still have to do this indirect method. So since you have to do this no matter what method you use, if you use the indirect method, you got to do what we're going to do. Use the direct method, you still have to do this. So let's spend our time doing the indirect method because I think that's going to be the most useful.